Okay, so now for the third and final part of our Chapter 2 example. We're going to pop back over to VMware. And first we have the trial balance. So we've, back here in the last video, we put in all of our debits, we put in all of our credits, and we did the math to get to see what our final balances were for the month. So now we're going to take those balances and we're going to first run them through the trial balance and then create the financial statements. The financial statements are the documents that we will use, or a business would use, to sort of see where it's at. The book talks about what you use them, who uses them, and what you use them for. But basically they say, they're really kind of a quick and easy way to see the income statement is a quick, easy way. Did we make money or did we lose it? Really easy, very clear thing that tells you. Statement of owner's equity tells you if the owner has, added or lost value. And the balance sheet just kind of shows us kind of the grand total of everything that we have. And so that kind of lets us know what kind of position we are there. So the first thing that I'm going to do, I'm going to pause the recording, and actually first I'm going to talk about the headings. This will be really quick. When you do a heading for a trial balance, what you'll do here is you will type the name of the business, which was Ressers. You'll need to do this for all of your trial balances. Here on a trial balance, we will say that it is for a particular date. And so this date, what month was this? It was July. So it'll be the last day of that month because it says we're doing it for the month. It'll be for whatever period you're doing it. If it's the end of the year, it'd be a year. End of the week, it'd be a week, right? So we're saying it's the end of the month, and July has 30 days. Maybe I'm wrong. Who cares? So that's what you do for the trial balance. You put that header. So now what I'm going to do is I'm going to pause the recording and just move all these balances over because you don't need to see me typing that. Be right back. Okay, we're back, and all I've done is simply moved all of the balances for CBF, cash, supplies, accounts payable, etc., to their corresponding space on the trial balance. So we're going to talk about the trial balance now. And what the trial balance is, it's known as an internal document, whereas the rest of the financial statements are external or outside documents. And what that means is it's just the trial balance is just for the business. It's just for us. And what it is, it's a chance for us to look at our debits and credits and kind of a first check to make sure that we've done everything correctly, or at least that our debits and credits balance. You can still make mistakes in there, but this will kind of catch big ones early, so you haven't done a lot. You don't end up doing your financial statements based on wrong information. And so you will just check if you want these numbers, the numbers below debit and credit, you want those to be the same, again, because debits need to equal credits, and that equation needs to balance. So that's what we'll do. We'll check and see if they balance. If they don't, you've made a mistake. Finding those mistakes can sometimes take a minute. Sometimes I've had students tell me they have taken hours. Don't take hours. That's my advice to you. If any homework you're doing, do it a few times. If it still doesn't balance, you just can't find that error, stop. Take a break. Looking at it with fresh eyes will always help. It's always helpful if you have the opportunity to. If you have someone who can just look at it and you can tell them what you need to see, what they need to be seeing, and even a fresh set of eyes, even maybe somebody who doesn't really know too much about accounting can find an error. But yeah, don't just, if it doesn't work after the first 2 or 3 tries, take a break, come back to it. And then if it still doesn't work a second time, send me a message. We'll figure it out. Okay, so let's check and see if this balances. It will. We know because we were so careful doing our debits and credits. So let's go ahead and auto sum this. Yeah, debits and credits, they gotta balance. And again, we're putting these based on their normalcy, cash, supplies, all of our assets. The debit normal ones we put on the debit side, all the credit normal ones we put on the credit side. So we have $38,782. What do we have on the credit side? Oops. So escape out of there. What? Oh, that's the wrong cell. Okay. So now we do the math here. And lo and behold, they balance. We are happy. You see this, the kind of the double line here, and there's these double lines here as well. In accounting, when you get to your final answer, you put double lines under it. It shows the reader that you're done, so that they'll know, you know, hey, this is the, instead of looking through a whole bunch of numbers looking for where your final answer is, you just look for the double underline. Okay, so that's the trial balance. If it doesn't balance, go back and work at it till it does. You've made a mistake somewhere in your debits and your credits probably. Good luck. Now we're going to move on to the income statement. So the income statement is looking at how much money we have made or how much money we've spent over a period of time. And just like the trial balance, you're going to want to put in the name of the business. But here, this is for, we're looking at the past month. So this, instead of looking at the trial balance, which is a moment in time, and also the balance sheet coming up as a moment in time, this is looking over a period of time. So we're going to put whatever that period of time is. So here we're going to say, for the month ending July 2020, or July 30th, either way would work. So now what we're going to do, the trial balance will balance. You know, you'll have your debit. Notice here that we don't have a debit and we don't have a credit column. Here we're just doing math. There's nothing to balance in an income statement because here we're just looking at, did we make money or not? And if you say, what is the income statement? A very, very basic income statement is revenues, money coming in, minus expenses, money going out, equals net income or net loss. If you've made more than you spent, net income. You spent more than you made, net loss. Let's take a look and see how this business did. So their revenue was $25.62. And they only had one revenue account, so that's it. So then they had their expenses. I'm just going to copy and paste these. And we will now get our total expenses by auto-summing only our expenses. And uh-oh, it does not look good for this business. It looks as if we have lost money. So what we're going to do is we will simply subtract our expenses from our revenues. You know, it's a new business. A lot of businesses, you know, lose money right at first. Amazon was famously not profitable for many, many years. So we lost lost $901 this month. Not the end of the world. Again, it's just a business starting up, but hey, this is what it tells us. And this is why we do this, because we know if we aren't keeping track of the books, aren't keeping good records, we wouldn't know. Now we know. So hey, maybe we look at bringing that rent down a little bit. That's a little high. The rent is more than we pay for our wages and our almost more. Not, well, it might be almost the other expenses put together. So this, you know, it's one of the uses of the income statement. See where that money's going. Most of it's going to rent. Maybe we look at finding a cheaper place. Maybe we look at getting someone to share the office with us, something like that. Okay, so this is how you do the income statement. The income statement works this way pretty much every time. This is a simplified version of it. There's a longer version that we may or may not get to, but this is the income statement. You will always do this. This is the first of the financial statements, and you always do the income statement first of those financial statements because you need that net income number to complete the second of these, which is the statement of owner's equity. And again, just like the other two, business services. So, oh, and this is Resser. I forgot to change this as well. Pause this while I change it. Okay, so I've changed out the name Mayo and put in Resser. The statement of owner's equity, like the income statement, is a reflection of what's happened this month. So this is what's going to be for the month ending. July 2020. Okay, so this is the first month of that business. We know that because in the first transaction, so they deposited the $25,000 in the name of the business, and up here at the very top of the problem, it says on July 1st, that Resser opened the business services. We know this is the first month that this business is a business. So what that means when we put, oh, let me change this to July, more pausing. Okay, now we have the dates correct. So this is the first month of the business. So what that means is his capital as of July 1st, think about the clock going from June to July. The capital for this business on July 1st began at 0, because that's where the business started from scratch. So what we're saying here is, like, say if there were, before you put the money in, the business may exist, but it's just an idea. There's been no investment yet, because that's what happened in A. A was that investment. And it doesn't really say when that happened during the month. It probably happened July 1st, but maybe it didn't. So when we began the month, this business didn't exist really, so it didn't have any money. The investments in July, that's where the $25,000 comes in. A lot of times students will say at the beginning of the month, that's where they put the $25,000. But for the first month of the business, and this is the only time this is the case, in the first month of the business, that capital amount is 0. Okay, so here is the $25,000 that he invested. Now we have to do plus net income for July. Well, our net income, we recall, was negative 901, so we're not actually going to be adding it, we're going to be subtracting. So we have negative 901. So our subtotal, for our investment plus our net income is going to end up being 25,000 minus 901. Oops, forgot to put an equal sign. I'll fix that now. So we're at 24,099. Okay, so things have gone down a little bit, but then we have to take care of our withdrawals. And if we go back to our trial balance, the drawing took out $700. So now we're going to subtract another 700. Okay. So now we subtract out the 700 for withdrawals and our increase in capital. In this case, we are actually going to have to change it to decrease because we've lost money. And that will be our decrease in capital is our subtotal from before, after taking out the 901 and now taking out the 700. So here we will take our 24,099 and take out our 700, leaving us with a capital amount of $23,399. And if you look in your book for your check figure, we'll see that that number is correct, $23,399. And so now, again, only in this first month, the decrease or the increase in capital, excuse me, this is an increase in capital. What am I talking about? Wasn't a decrease in capital, it's an increase. Because even though we lost money, we still were on the plus side. Apologies for that. So our increase in capital was $23,399. But again, in this first month, and again, only in the first month, is the increase in capital and the sort of final capital amount the same, because here we're starting from scratch, starting from 0. Now, next month when we do this, or next week, or whenever we do that, the next statement of owner's equity, this amount here, the $23,399, that's what will go in for the capital one. So in August 1st, so for August 1st, next month when we do this, it's going to be $23,399. We'll see if there are any investments, see if we made or lost money. We'll go through the same rigmarole, but we'll always have a number here after that first month. First month's the only time it's 0. Okay, so now we always do the statement of owner's equity second because we need this final capital amount for the balance sheet. Now I'm just going to go ahead and move this down here. $23,399. And now I'm going to pause the video once again to bring over all of our totals from the trial balance to the balance sheet. This is just going to be simply me moving those numbers over. Okay, as you can see, I've moved them over. And now we're going to check to see if our balance sheet remains in balance. Because here we have assets, liabilities, owner's equity. As we know, total assets should equal liabilities plus owner's equity. For the balance sheet, once again, rest or business service. But the balance sheet is kind of like the trial balance, and it happens in a moment of time, at a moment in time. We're looking at what we have at this second when we do this, this report. It's not from a period of time, it's what we have exactly right now. So here we just put the date. We'll say July 30th. Okay. Okay, so we see here we have all of our assets together. We see what this is down here, 34,619. Look at these two together, see if our assets and our liabilities plus owner's equity, 34,619. Balance sheet balances. This is what we want to see. Now we know we're done. It balanced, and we can kind of go about our day. And you'll be doing financial statements for the rest of the quarter. They really are. It's the, these are the documents that let bankers, that let managers know what's going on. Very important documents. Okay, that's it. Thanks, everybody.